Welcome to our financial wellness presentation on the basics of life insurance. Today we will discuss who needs life insurance, what type of insurance is appropriate for your situation, how to estimate how much life insurance you need, and a few things to consider when purchasing life insurance. The most common use of life insurance is to provide financial support for your dependents. It can cover the costs of final expenses. Life insurance can maintain the family's lifestyle even without the breadwinner's income, and pay for future costs like a college education. In addition, it may help dependents pay off accumulated debt like a mortgage. Stay-at-home parents also contribute valuable services to the household, such as child care. Couples with children should consider how much these services would cost if the parent was no longer there to perform them. Many individuals want to leave money to their heirs, and life insurance can help them accomplish this legacy goal. Single people who have debt that has been co-signed by others, such as student loans, should have life insurance to cover this debt in the event of their death. Most seniors have paid off their debts in preparation for retirement and do not have dependent children, but they may still need life insurance. Seniors may want insurance to cover their funeral or final medical expenses. Life insurance, which accumulates a cash value, can be used to create a retirement income. Also, more wealthy seniors may choose to carry enough life insurance coverage to pay estate taxes for their heirs. We will now address the question of what type of insurance is appropriate for an individual's situation. There are two main types of insurance: term and permanent. Additionally, permanent insurance has other variations such as whole life, universal life, and variable life. The difference between these permanent insurance options are beyond the scope of this presentation, but provide varying levels of flexibility and risk within a policy. Term insurance is life insurance provided over a specified time period. The term is typically 5 to 30 years, and the policy expires at the end of the term. Term insurance is typically the type of insurance provided by an employer. Term insurance does not build a cash value, meaning the policy does not serve as an investment. It is intended strictly to provide a benefit payment to a beneficiary in the event of death. For this reason, term insurance tends to have much lower premiums than a permanent policy with the same death benefit. The premiums on term insurance are determined by the likelihood of your death during the term. Factors include the length of the policy, age, gender, the death benefit amount, smoking habits, your family health history, and whether you have dangerous hobbies like skydiving. It is very important that you be completely honest when filling out the life insurance application. Any inaccuracies uncovered by the insurance company could result in the elimination of your insurance benefits. Permanent insurance is intended to provide coverage for your lifetime. The policy accumulates savings for the policyholder over time. A permanent policy can serve as a source of liquidity. You can withdraw the cash value or borrow against it at an interest rate specified in the policy. However, withdrawals and loans can jeopardize the health of the policy and should be monitored professionally. Depending on the type of policy, premiums can be either a fixed or variable amount. The premium is used for two purposes: life insurance and savings. A portion of the premium pays for the life insurance provided by the policy, so your beneficiary will be covered if you die. The remainder of the premium is invested for you as a form of savings that builds a cash value over time. Premiums are influenced by the same factors as discussed for term insurance, but because of the savings component, permanent insurance premiums will be substantially higher than term insurance for the same amount of death benefit. Whether to use term or permanent insurance depends on your need. If you only need a death benefit, and that need will end in time, term insurance is the right tool. If you find the savings aspect attractive, or have a need for a death benefit that is lifelong, permanent insurance is the better fit. Your life insurance needs will change over the course of your lifetime. Once you decide on the type of policy that suits your needs, your next decision is the policy amount. If your need is income replacement, consider the income method to determine the policy amount. This method normally specifies the life insurance amount as a multiple of your income, such as 10 times your salary. For example, if you have an annual income of $75,000, this formula would suggest that you would need $750,000 in life insurance. This method is very easy to use, but it does not consider your age and your family circumstances, including expenses, number of children, etc. Therefore, the income method may be overly simplified. An alternative method for determining the insurance amount needed is the budget or needs method, which considers expected future expenses in conjunction with your current financial situation. The budget method estimates the amount of future funds that will be needed so that the insurance coverage will be adequate. Ideally, life insurance should provide the financial support for family members to continue with their lives in pursuit of goals, just as if the breadwinner were still alive. When utilizing the budget method, some important factors to consider include how much your family needs to live comfortably each year, special future expenses such as a college education for your children, debt repayment, what can your spouse potentially contribute to the family's finances, and the value of your existing savings. Also, distinguish between needs and dreams. Life insurance should not be viewed as a means by which the surviving family members can suddenly become rich. A financial advisor can help you determine the optimal amount of life insurance based on your individual needs. When purchasing life insurance, be sure to name a beneficiary to receive the death benefit should you die. You can name multiple beneficiaries and specify how you want the death benefit to be divided. You can also name a contingent beneficiary who would receive the benefits in the event that your primary beneficiary is no longer alive. You can change the beneficiary anytime you wish, but until you do so, the existing contract will be in force, so don't forget to change beneficiaries after major life events such as marriage, divorce, death of a beneficiary, etc. Life insurance has additional income tax benefits. When paid, the death benefit is not considered taxable income to the beneficiary. If structured properly, a death benefit will also be free of estate tax. For permanent policies, the cash value builds tax-free. If you withdraw a policy's cash value, the withdrawal will be treated first as a non-taxable return of premium, then as a taxable distribution of growth. In addition, there are no income tax consequences for taking a loan from the policy. We covered a lot of information in this short tutorial, but here are the important takeaways. Life insurance has many uses, but is typically used to protect your loved ones financially should you pass away. Term insurance provides a death benefit for a set period of time. Permanent insurance provides coverage for your lifetime and builds cash value. Consider what your needs are when determining what life insurance to buy. Periodically review your coverage and make sure that it is adequate given your needs at the time. Thank you for listening to our presentation today on the basics of life insurance. I would be happy to assist you with any individualized life insurance questions you may have.